Many people wonder why the U.S. economy seems to be doing so well. One of the reasons is because the stock markets have been at all-time highs. Now, there's a lot of manipulation of data and a lot of different things that these massive corporations do to keep their earnings high, and some of those cost Americans their jobs and require us to pay a lot more for goods and services than we probably should. In this interview, I sit down with Josh and Carl, who work for a financial advisory company. Now, they only work for the rich, but I think that it will be very clear that you can read between the lines of what's really going on and decide for yourselves if we're in markets that are unsustainable. I hope you enjoy the show. All right, Josh, it's been a while, man, since we sat down together, podcasted.
Yeah, thanks for having me back.
Yeah, a year and a half ago. Lots going on in the markets. It's crazy. I mean, we have a lot to cover and unpack here today, but you brought Carl with you. So, Carl, why don't you just start out and tell everybody, what you do and, how long you've been in the business, that kind of thing.
Sure. Hi, Todd. Thanks for having us here. My name's Carl Noble. I've been in the industry for over 20 years. I'm responsible for our portfolio strategy for our clients, so making the investment decisions as we make changes and manage the portfolios for our clients.
And a lot of money.
We manage a few $1 billion these days, so yeah.
So you're managing $4 billion, I think you told me. How much do you actually?
We have different strategies in the firm, but the strategies we're responsible for around $3 to $4 billion.
Yeah, it's a lot of money.
So
and local too. You guys are local.
Very local. A lot of clients just in the Mid-Atlantic, Maryland, D.C., Virginia area. But our firm is now national, headquartered in Boston. We have offices, a few other offices around the country. So
you don't really do you deal with the investors one-on-one, or that's mostly Josh, what he does?
Josh is the one who deals with clients more personally.
They're kind of like behind the scenes,
exactly.
Deciding where to move, to suggest the moves and things like that.
Yeah, as I'm sure you're well aware, just keeping tabs on what's going on in the markets and the economy is a full-time job, really. So the advisors have their plates full, managing the relationships with the clients themselves. And then, we assist by, taking that investment function off of their plate and hopefully, adding value by doing that for them.
I got a lot of questions for you, Carl.
Sure. Okay.
Yeah, I mean, that's, I have a lot of questions, back end stuff. Yeah. So it'll be fun. But Josh, just kind of tell everybody what you do. You're more of the consumer facing, calming nerves, kind of, having conversations when people are panicking, I guess. Sometimes they're panicking, right?
Not too much panicking, but if it does occur, then yeah, I mean, part of my job is trying to, come at it from a factual basis, not make it an emotional thing. But yeah, I work with the clients day to day. I have about 125 clients that I work with. My book of business, about 200 million. I'm really doing, kind of the relationship management and financial planning, some tax planning, those types of things. Kind of, more of a financial planning aspect, and then just really being able to kind of translate what our investment team, led by Carl and his group, is doing in clients' portfolios.
And praying they're right.
Yes. Yes.
Right.
Yes.
That they guessed right.
Yes. Right? They're right a lot more than they're wrong.
That's right. And I say guess. I mean, you don't want to think that you're guessing with people's money and strategies, but I mean, nobody has a crystal ball. And I do want to talk about insider trading and things like that because, I think it does exist. I don't know how it can't not exist. It's almost like people getting loans. I look at it, a lot of people, investors, they will get a loan and like they're going to live in the house. But a lot of them have no intentions on ever living in the house, and they're signing affidavits saying they're going to occupy the house. But, you look at it and you go, okay, well, what's the percentage of them that get caught? Well, I mean, it's bad when they do, or if they do get caught. But so I do want to talk a little bit about, what happens behind the scenes. But let's kind of dive right in because the elephant in the room is 40,000. Right. So, I mean, the Dow hit an all-time high. I think it was on May 16th, it hit over 40,000. First time ever. Right. So, I mean, Josh, start with you. I mean, does that make you nervous?
Well, first thing I would say is I think, and Carl, you can jump in if you disagree, but I think we that's something we look at. But I think the S&P 500 for us is definitely more of a barometer of what's going on in the markets.
Okay.
The Dow is 30 stocks. The Dow quite frankly, when you look at compared to the S&P over the last couple of years, has underperformed the S&P. But I also think, and again, I'll kind of switch gears more to the S&P. The market is overall, I would say, overvalued. But when you really kind of dive in, and I'm sure you're probably going to ask about the Magnificent Seven, or as we've talked about more this year, the Fantastic Four, those stocks have kind of, their outperformance, those potentially are very overvalued. But when you look at the rest of the market, the valuations are actually pretty fair and pretty much in line with what we'd want to see, right? So you have a huge section of the market that has not really performed very well and is very fairly valued. And then you have a very small number of stocks that have performed outrageously and are overvalued. So on the one hand, it's like, it does scare you a little bit maybe, just because, you hit these new highs and you either have people who think we can go higher or they think we're definitely going to go lower. And I think Carl can talk a little bit more about that. But, we've seen earnings sort of across the board be trending in a positive direction. And one of the things that we say, internally is earnings drive stock prices. So if earnings are going up, stock prices go up.
What's the lag on the earnings? I mean, we're looking at quarterly reports, right? So, I mean, we're really not, that's our gauge. So at any one given moment, we're at least looking at data that's the last quarter, right? So if we look at quarter one, I mean, we're well into June now. I mean, what are they, how are they valuing profits? I mean, when we look at consumer spending, I mean, inflation has been off the rails, right? I mean, do you think a lot of this, the earnings reports are as a result of the lagging effect of stimulus?
I think some of it was attributed to that, but these cycles that normally are pretty well synced have been so disjointed and thrown out of whack because of COVID. So what's interesting is, the market had a big down leg in 2022 when interest rates were going up. Earnings were actually still doing okay during that, which is a little unusual. Then we had what we would call an earnings recession last year, where earnings actually fell for a few quarters. Now they're starting to pick back up again. So, I would say typically that would be the case. Earnings a lot of times follow the direction of the economy. It makes sense if the economy is picking up or slowing down. Earnings a lot of times will do better or worse. But a lot of this stuff has been thrown out of whack, like I said, because of the pandemic. So we're a little bit disjointed right now. But as Josh said, we're starting to see some signs that earnings are picking up a little bit relative to where they were, a year ago or so.
Yeah. I think of publicly traded companies, as they differ from, most of your small business owners that are not publicly traded, they're always concerned about bottom line. I mean, that is the concern, because if they keep their earnings respectable, their shareholders have confidence and they keep their money in and they continue to buy, right? I mean, that's a fair assessment. I can remember back in the great financial crisis, what was happening was, and one of my clients at the time was the Restaurant Association. And I can remember, publicly traded restaurants they were just cutting locations, slashing jobs, doing whatever they can to keep those earnings still present in the midst of everything falling apart. And when I say that, because I think about, the unemployment numbers not being right. What's being reported is not accurate. If you've been on unemployment more than a year, you're not even counted anymore. The amount of part-time jobs that are out there. There can be a masked occurrence here that we don't see for quite some time. And I'm not saying that it's going to happen, but it does make you think, right? When you see consumer spending draw back, and we know that's happening right now. Now, whether that will show up in this quarter or not, but when we look at that, how focused are these companies to saving money right now as opposed to spending money? So when if we had to look at their income statements for the first quarter and, diving into a lot of these companies, would you say that to keep earnings, that they've pulled back their expenditures?
Some of them are doing it through cost cutting. That's true. And it kind of depends on the industry. So Josh mentioned earlier, some of the big cap tech companies are still just seemingly printing money because of this excitement about AI and different things like that. But other consumer facing businesses is what I think you're talking about, where there have been inflationary pressures. There have been some very notable ones, McDonald's, Starbucks, some very big names that have warned that their consumers are experiencing a lot of pressure right now. Walmart's
Target,
another one, Target. So those are some good examples of more consumer facing companies that are saying, hey, we're starting to see that people are feeling more and more stressed now that interest rates have been kept at a high level for a while. And that is something I think to keep a close eye on as we go forward from here.
Yeah. And then when you look at that coupled with, we go on some of these, let's just talk about the stores because we're focused. You look at McDonald's, they were really pushing full speed ahead on completely automated, non-employee restaurants where you go in, no one's working there. The whole start to finish is automated. You look at all of your box stores like we talked about. There's no cashiers, right? Everything is automated. You can't find help in the aisles. So I guess my question is, and when we look at, and this is just for your opinion, the products are junk. The products that we're buying right now are junk. I went out to look for tiki torches. It's crazy, right? So, it's summertime. I like them. My wife doesn't, but I do. And they keep the bugs away, at nighttime. It's you put the whatever. They're garbage. I remember, 20 years ago, I bought tiki torches, and they were metal that went into the ground. They actually they lasted 20 years, right? But this is the kind of cost cutting that's happening right now. They're giving us substandard products. They're cutting, the staff. We're doing the work in order for them to save their earnings. When does that catch up?
It's a great question, but I think you make a good point that, with companies, when they are so focused on the bottom line, like you say, one of the biggest costs that goes into that and where they can find the most efficiencies is reducing headcount in a lot of cases because labor is such a big input cost. Or like you said, they're kind of cutting quarters on the quality side potentially too. So, ultimately, I think the cream kind of rises to the top, if you will. So if you're an individual company that's doing too much of that, I think that's going to be reflected in your stock price ultimately because people will notice and earnings will probably reflect that ultimately. But it's a great question in terms of what the lead lag is to ultimately getting there.
Yeah. And I was talking about the GFC in 2008 and I was talking about the restaurants. And I can remember in a meeting, I was listening to a restaurateur talk about the fact that they were hyper-focused on the consumer not seeing how badly they're doing. So what they did was they kind of repackaged menus to make like a dinner for two. So they could produce a cheaper, forcing them to order and eat the same thing. So they'd have 4 different things on the menu that were more like a dinner for two at a discounted price, but it saved them in the long run. But they said, and here's the difference between then and now. Back then, they were concerned about the consumer experience and the consumer not feeling the pain of not having enough staff. But over the last 10 or 15 years, they've killed us with that. So essentially now what's happening is, they're literally, they don't care. If you have to sit there for 15 minutes waiting for somebody to show up to give you a drink, we have been so accustomed to bad service that maybe, this training over the last 15 years since the GFC, maybe they'll fare pretty well, but then we'll have job loss. But Josh, let me talk to you about, kind of tell us, you have to be getting the calls from people saying, you make your money and you can correct me if I'm wrong, but you make your money based on people investing in your company, right? Giving you money to work with to help them make money, right? That's what they want to do. They want to make better than a CD. They want to make better than, they don't want inflation to just eat away their cash. And we'll dive into that a little bit because I want to talk about gold and Bitcoin and get your opinions on things like that. But somebody's coming to you now, new customers. You're managing 200 million. There's probably a lot of that you've had for quite some time. But as far as growing your business or growth, if you had to look back over the last 10 years or so, are you seeing the slowdown in your growth of new money coming in to manage? or, and the bulk of what you do just being old clients? Kind of what's the offset of that? Have you seen a pickup or a decline?
I would actually say a pickup.
Okay.
And I don't have all the numbers on this, but I mean, we're sort of, with boomers retiring, dying, we're sort of at the beginning of a wave of the largest transfer of wealth in history. And so you're seeing, a lot of people come into money, whether it's inheritance or, quite frankly, working in, software or tech or AI or whatever. And there's a lot of people that are coming into wealth. And, when we were talking earlier, I think it was before we were, on camera, you were talking about teaching people about real estate. And, there's more tools to learn about how to manage your money than there's ever been. But at the end of the day, you got to have this is an acronym I always use, TWA. You got to have time, you got to have willingness, and you got to have aptitude. If you don't have all three, it's not going to work. And usually somebody's missing at least one of those, maybe two, or maybe all three. And so we find people are wanting, advice of somebody that's going to be objective, not going to be emotional about it. And then, it's very interesting. I have a couple clients, they've literally hired me as their succession plan. It's either a husband or a wife that manages all the money. And they're concerned about when they pass, either the wife or the husband doesn't know anything about it. And they want to have me in place to help them when there's that, that transition time.
Yeah.
But we've definitely seen some growth.
You've seen growth.
Yeah.
You mentioned boomers. A lot of people think we're in the financial mess that we're in right now because of boomers. What do you think about that?
I don't know. I mean, that's kind of hard to say, right? My parents are boomers, so I don't want to throw them under the bus. I mean, obviously, when we go back, hindsight's 20/20, and I think a lot of decisions were made with best intentions. That's probably about all I would say about that.
Yeah.
Yeah.
Where do you think? I mean, how do you think the boomers contributed to, I guess, the economy that we have right now? I mean, why would a millennial say that can't afford to buy a house, that is not making the wage growth that they would hope to, right? A lot of people are struggling. So you have a big disparity of the different classes of people, right? Or generations is best said. The silent generation who went through the Depression, or a lot of them, or their parents did, and they were products of that. Don't waste, we save everything, we only like to buy things that are going to last forever. To the baby boomers that were like, yeah, well, that was my parents, and this is great, and we're just going to live and spend and, make money out of thin air kind of thing. And then you have Generation X, which is me, right? And we've come off the heels of some prosperity from that. But what do you think was the biggest turning point with the boomers where they're being blamed right now by the millennials and the Gen Zs?
I mean, I think I'd probably just pick two things. And again, this is 100% my opinion. One is I don't think that, boomers and then from there on have prioritized financial education. The fact that we have to study some of the things we study in school, but we don't learn about, and this would be the number one thing, debt. What's good debt? What's bad debt? The ramifications of those two things. I would say that's one. And then I think, I'm a capitalist, so it's kind of hard for me to say this, but, executive compensation, right? So you have a company, the CEO makes $100 million, but you've got people who don't make a living wage, right? So I don't know if that's all boomers, but that definitely has happened. I think those two things are, make it hard. That would probably be, but I think the biggest one would be debt and understanding debt.
Yeah, I think you hit the nail on the head. I think we do a really bad job of financial literacy, teaching literacy. How do you make money? And it's interesting too, because a lot of policies, and I just interviewed someone that was in Reagan's, he was an economic advisor to Reagan, and podcast just pushed out last Saturday. But the fact of the matter is that we have had so many bad policy decisions made by boomers, right? So if I had to put my finger on it, I would say people should have term limits, in government, right? We should have term limits. And if you're a boomer and you don't know what the hell's going on, you shouldn't be in office, right? You're living in some kind of a bubble. You're not connected with the rest of society, right? You don't even know what the struggles are with the millennials and the Gen Zs that are coming up and now the alphas, right? And so we're not really designing policy to encourage work. So we're encouraging complacency, laziness. We're not encouraging, or incentivizing work and teaching people how to be capitalists in what should be a free country and a country that was formed on the principles of capitalism and being able to excel and be encouraged to do so. All right, I hope you're enjoying this interview so far. I did want to take a moment and tell you that this podcast is brought to you by none other than SachsRealty.com. So if you're looking to buy, sell, or rent and you're in Maryland, we'd love to serve you. And if you're anywhere else in the country, click on the map of the United States and find an agent near you. Should you not see an agent serving your city, please send me an email personally, and I'll be glad to point you in the direction with someone that I trust. Now back to the show. Let's kind of switch gears. We'll get back to the markets. And like I said, I want to talk about gold and Bitcoin and what your opinions are on that. But I want to talk about just kind of like your opinions on this. We're in an election year.
It's not a loaded question.
Right? When I look at the headlines now, and I spent hours doing this over the last couple of days, they are rallying the dollar. I mean, if you turn on the news, headline articles, they're saying the dollar is strong. Meanwhile, you have people on YouTube, people that understand the financial markets, scratching their head saying, what are you talking about? The dollar's collapsing. We've had, never had the debt that we have now. And I understand that debt can be a good thing if it's used in the right way. What's your opinion on the dollar?
Well, we own gold in the portfolio, and gold has been near all-time highs.
It has been
this year.
It's had a pretty nice move over the last few quarters. Going back to your question, I mean, I think the interesting thing in terms of the dollar and how people view that is it's always measured against what, right? So is the dollar weak or strong versus another global currency? Well, we just saw today, there were a whole bunch of elections over in Europe. And the euro sold off pretty big as a result of that, which pushes the dollar up, actually. So it's not always necessarily is the dollar weak or strong based on the fundamentals here in the U.S., but also sort of vis-a-vis, what is it, again, a dollar-euro type of relationship, or in other cases, Japan has been driving their currency much, much lower to try to rescue their economy. So, again, the dollar, it just comes down to what is it being measured against. What's interesting, as Josh just alluded to, is that gold has actually appreciated against almost every currency over the last, again, I'm going to go back probably 6 to 9 months. It's had a pretty sharp move higher. And that's been virtually against all global currencies. So that's kind of maybe telling you something right there in terms of, getting into that argument of fiat monetary currencies versus, precious metal and real assets and those sorts of things.
Do you think there's a possibility that we would have a dollar collapse?
There's certainly a possibility. I think it would be related to what you touched on, which is the size of the debt currently and the rate that it's growing. So it was already a problem back in 2019 in terms of how much debt was being accumulated over the years. But the response to the pandemic has, accelerated the trajectory that much higher, in the last 4 to 5 years. So now, we've piled another huge layer of debt on top of what was already a big layer of debt. And so I think at some point, if there isn't the political will, which doesn't exist right now, if there isn't in the next few years to address that problem of the size of the deficits that we're running, which is only adding to the debt, then ultimately, yes. I mean, I think you will run into an issue that the currency will respond to that. And it probably is coupled with, typically when that happens, you will see inflation reaccelerate again, typically. So
Penn Wharton just published an article. It said that within 20 years, if we don't have new policy or some type of effort to reduce the debt, that within 20 years, it won't matter how many taxes are collected, that the U.S. would default on its debt. What would that mean? Would that be a debt jubilee with bonds?
It's a good question. You wouldn't want to own bonds in that environment. Clearly, now the U.S. doesn't necessarily have to default, but the only other option would be to inflate it away. So either one is not good for individuals and consumers and the value of their personal assets necessarily in that type of environment. We've got to remain somewhat hopeful and optimistic that eventually they'll address those problems. But like you said, neither side is really too focused on that. The fiscal hawks have seemingly disappeared in Congress sort of overall, I would say. And then going back to your earlier point too, some of this are promises that have been made over a long period of time. So the entitlement spending, it's kind of easy to do the math when, like Josh said, the demographics of how the country is aging and how many people are going to be entering some of the entitlement programs that the government has promised translates to a lot more debt that's going to have to be issued to pay for those things. So again, there's going to have to be some hard choices to make, but politically, nobody really has the appetite to do that because that's a hard way to get reelected, right? Is to make those tough choices.
Yeah. Well, you said something very interesting. We have to inflate it away. The issue becomes, how do we do that when businesses can't afford to pay higher salaries?
It's a great question. I hope we don't get to the point where that becomes more of a reality. But again, what you'd like to see are policies that encourage more, or are business friendly, but encourage more business formation, innovation, that sort of thing. Because ultimately one way, it won't be the only way, but one way is to try to grow the size of the economy a little faster, which would help, from a sort of a debt to GDP type of relationship, which again has gone up a lot. If we can grow the economy a little faster, which would involve some smarter thinking from a policy perspective, that would certainly help. But then, yes, some tough choices still have to be made in terms of where can we cut some of the spending that is a little excessive right now, it seems like.
So I want to present something to you. So Dr. Arthur Laffer was my guest that I was talking about. He was actually with Reagan, but prior to that, Nixon, and was also in the Clinton administration as far as, from the economic advisory role, and then was also with Donald Trump. He indicated that a lot of our success or prosperity has to do with the percentage of taxation. Mm-hmm. And so he developed what was called the Laffer curve, or he didn't develop it, but he was associated with it after 1974 dinner. It's a very interesting podcast. If you haven't heard the story, it's worth watching. But what he said is the Laffer curve basically was somewhere between 0 and 100% of taxation. You would have a government that would have enough money, but could cut taxes and sort of stimulate the economy. And what he said was, when you get to a too high of a taxation, people look for ways not to pay taxes. Mm-hmm. They don't feel good about it. They either don't produce, or they'll spend their money doing other things that, with the loopholes, instead of paying taxes on it. But if there's a certain percentage of taxation where a business would say, you know what, I'm cool with that. I don't need to go buy things that I don't need at the end of the fiscal year to just absorb our profits or write something off. We would actually be okay with paying 25% or 30%. So what he says is, depending on what that number is, people would actually pay more taxes. That would give the government more money so we'd have tax cuts. They'd have more money to buy down the debt, right? Because they'd collect more taxes. And businesses would be thriving to the point to where they would be hiring and doing more with their success, right? That's a concept. Do you think that, Josh? I asked you. Do you think a lot of this hinges on taxation?
We have one of the most complex tax codes in the world. I think, a lot of corporations aren't paying anything. We know that. That's pretty well documented. I had a friend who unsuccessfully ran for governor of Maryland many years ago, and his idea was to have no state income tax for corporations to get them here to try and, build our job base, right? Build the economy in Maryland, basically off of, consumer spending. Part of our job is to help our clients,
avoid tax.
Well, I wouldn't say legally, yes. Yeah. Legally, yes. But right. There's tons of loopholes.
They're looking at it. A lot of them say, well, I don't like what they're doing with the money as they collect.
I think that's a great point. That's one of the biggest parts. I don't know if you saw the congressional hearing a couple weeks ago where the congressman held up the bag of, I think there were rivets or something like that, and said, how much did we pay for this? And I didn't know. And they were like, it was like $90,000 or something like that for a bag of, metal rivets. So there's definitely, there's a distrust of the government for how they spend the money. That's a part of it. But yeah, there's got to probably be a sweet spot to Laffer's point where people are going to be like, I'm willing to pay that and I'm okay with it. I'm not going to be trying to avoid, all these things.
Yeah.
So
oil, let's talk about oil because this is a big, it's a controversial issue. Mm-hmm. We're talking about policies of clean energy, fossil fuels, concerns with the environment, whether they're substantiated or not. We're not going to get into that. But do you think, oil has rallied for what, 10 years or 15 years? Oil was down. People were losing money in especially exploration, refining, things like that. Do you think that, where do you think we're headed with oil?
I'll let Carl answer that. I worked at a firm prior to CW Advisors, and one of the, I guess you call it investment products. It really wasn't an investment product. It was a tax play, back to your tax point, domestic drilling programs. So, probably a lot of your viewers are aware of this, but there used to be, and I think there still is, an incentive from the government to invest in domestic oil production. So you could invest money in these drilling programs and you'd get a huge percentage of what you invested into it would be a tax write-off. The idea was to do it for the tax write-off, and over time, through the royalties of these wells, you'd get your money back. Well, about 2013, 14, OPEC basically said, we're going to just glut the market with oil. We're not going to cut production at all, and we're going to let drive prices down, which they successfully did. It put a lot of the U.S. smaller drillers and production companies out of business, and oil was very cheap. So the one thing, though, that's very interesting about that is you hear that it's more expensive for us to get it out of the ground here, which is true, but we don't own the oil. It's companies that own the oil. So let's say back then, I think it was about $30 a barrel to pull it out of the ground. That's what it cost in the U.S. So that's kind of your break even. Oil prices were down that low. The Saudis and other OPEC nations, they could pull it out for much cheaper. But because of all the things that it pays for within their government, it pays for all their social programs, all their entitlement programs. Their break even was actually closer to like $80 a barrel. So, that period of time when oil was driven down so much, that was intentional. I think, it's definitely come back. It's probably more where it historically has been and probably will stay there. The future clearly is probably green energy, particularly electric, but we don't have the infrastructure to do that here. So without a ton of infrastructure spending, we're a ways away from being able to have, majority of the cars on the road be electric vehicles.
Mining for the lithium, getting everything. That's expensive.
It's very expensive.
Producing batteries.
The current transportation secretary was on one of the news shows a couple weeks ago, and I think that, I'm not going to get these numbers right, but it was something like 5 billion, some very large number has been invested by the government to build charging stations. And the reporter said, you've only built 7 of them. The goal is a lot more than that. And he kind of backpedaled and said, well, but that's by 2030. And she said, yeah, but you've only built 7 of them. So we're so far away from that infrastructure. Oil is not going anywhere anytime. It's going to be a needed commodity for.
So you like that sector?
We do like that sector. And, you go back and look at 2022, our investment team, Carl and our team, we were over allocated to oil. Our client portfolios were down, as most were in 2022, but that helped quite a bit. So yeah, we believe in that space.
So you had insight to that, and you were actually buying it back then. And
yes,
yeah,
yes,
yeah. When people were afraid because they're saying we're going to get rid of the combustion engine and we're going to eliminate the dependency on oil. You guys saw that that's not going to happen. Yeah. Or
well, it's not going to happen anytime soon.
Yeah, right.
The way we're going right now, it's not going to happen anytime soon.
Right. It's not practical.
Not at this point.
I mean, you know, a lot of people say, well, they're building these 15-minute cities. If you look at Agenda 2030, and I don't know if you've dove into any of that, but, you know, United Nations and World Economic Forum and, you know, things that typically, you know, bring suppression on YouTube videos and channels talking about it. But, you know, you look at it, it's interesting because if you take their policies and you look at a lot of the counties in the states, almost verbatim is how they're building these communities. They want to cluster things together, and we start seeing all these solar farms going up, you know, all over the place. And it's almost like the only way that they will win at the control or, you know, eliminating our dependency on fossil fuels is when we can't leave our, you know, we can't leave our 15-minute city. And I know it sounds far-fetched, but I don't believe it is. You know, a lot of people say I'm not conspiratorial. With my thinking, I just see as a developer, as a real estate developer, and someone who's been in this industry for a long time, I can see where the trends are going. You have a piece of property. You own a piece of property. Your family gives you a 100-acre farm, whatever. You want to sell that off to a developer or develop it yourself. You know where they put the houses? Right on top of each other.
Oh, yeah.
They come up with these weird lot sizes where you have to have your houses right here and everybody has this weird piece, and part of your 5 or 10 acres is way down there, and this little dog leg that goes always like, how do you even chop this up? You can't even build your houses where you want. They give you a building envelope, right? Where you can, somewhere on that property, they're going to tell you the house goes right here. Right. So that you can't even. So when we look at it and we talk about oil and things like that, and I think that's the only way is expanding upon those kind of policies is the only way that they'll be able to get the control to actually restrict it if they want to enforce it. Because we know you get an electric car, and I didn't see either one of you pull in an electric car. You don't own one, do you?
I do own one.
Oh, do you? Is your car electric?
It's out there, yeah.
Oh, okay. I didn't think it was. All right, you don't. So you do.
50-50. I have a gas car also.
Okay.
He does.
We have
okay.
two-car household.
So let's talk to you about this.
Yeah.
You ever get worried when you're traveling of where's the next charging station?
Sometimes. I mean, it depends how, you know, if you go off the beaten track too much. If you're staying on the highways, it's a different story. But absolutely. I mean, to your point, there are far less charging stations than there are gas stations still, despite the fact that they want to expand that network. So it's definitely a consideration for someone who's thinking about doing that.
So you're out traveling and whatever. Yeah. Maybe use your other car when you go away, you know, cruising at a beach or whatever. But so, I mean, you're out cruising around. Yep. You stop off to give your car a charge. Yep. How long does it take?
It depends. Probably about 15 or 20 minutes. So, you know, longer than a normal gas stop, that's for sure. I would say that is getting a little better in terms of the charging speed. But, you know, the other thing too is you pull into a lot of these and there aren't nearly as many charging stations as there are gas stations. So you could also have the issue is if you pull in, you can't find a spot to charge potentially, like if there are a lot of other cars there. So,
and what do you do?
You wait.
You wait.
Guess. Yeah, you wait long.
Want to continue.
Hopefully you don't have to be somewhere in on time. Yeah.
I mean, is that practical?
Again, not at the moment. I mean, they're trying to get from A to B, but it's
with all the people that we have. You know, I mean, in Maryland, we have more than 6 million people.
Yep.
Can you imagine? Let's just say we have no fossil fuel vehicles. Let's just say that, right? We eliminate them.
Yep.
You take 6 million people. Only 3 million of them work, by the way. It's probably not that many, but let's just give the benefit of the doubt. Let's say that there's 3 million working people. What's the percentage of them have cars? Is it fair to say half?
Oh,
1.5 million cars? What would it take to charge 1.5 million cars on a daily basis? And we're this big. We're tiny compared to California, Texas, right?
Yeah.
You look at these other states, we pale in comparison to population.
Absolutely.
I mean, we got big issues here, right? That it sounds good. It sounds good.
Right.
But when we get down, I mean, you guys are clearly, you're advising, you're looking through all that, you're strategizing, you're not saying it's BS, but you're saying, look, we believe we're going to invest in this, and it's paid off. Get back to the election year for a second. We talked about the stock market booming, reaching all-time highs. they're rallying. JP Morgan saying, hey, look, these are still, a lot of these, fintech and stuff, they're undervalued and they're going to keep going. We know what they are, the Magnificent Seven. We can put them up on the screen. What would break your confidence in the market? What kind of, in the back of your minds, I mean, you both deal with money, man. I know the responsibility of dealing with somebody's home purchase.
Yeah.
It's a big responsibility for me, not having 200 million, 4 billion under management. That's a lot of pressure. Probably some sleepless nights.
Yes.
Right? Can't even imagine. And Josh, will start with you. What's in the back of the mind? In the back of the mind?
I get nervous when they get nervous, because I obviously rely on Carl and his team to make those decisions. But I mean, I think you start seeing more layoffs. That's a concern. Inflation obviously was a concern. I mean, I have 4 kids. I get a little concerned every time I go to the grocery store and look at the bill. So, just seeing that. And honestly, you've talked about real estate. Obviously, you're in the real estate business. I mean, one of my big concerns for my kids is them being able to buy a home. I think the American dream of owning a home is still out there, but I think it's a lot more difficult than it used to be. People talk about interest rates. They're very high right now. Now, I had an 8% mortgage when I bought a house in 2000, but my house was $150,000. It wasn't $500. And so that's a big difference. So I have nieces and nephews. I have people I know my daughter just got married. They want to buy a house. And the question, they're like, what's your advice on real estate? And I'm like, lower your expectations. You're not going to be able to buy the single family home. A lot of younger people are not going to be able to buy the single family home. They're going to have to buy a condo. And, you move up, maybe then you buy a townhouse, then you buy a single family home. So I'm looking at housing. That's a concern to me. Inflation's still a little bit of a concern. And then
how about macro issues?
Yeah, some of the macro issues. I think we try and really look at the data and not be emotional about it. And that's, again, one of the reasons why people hire us, right? To look at the data.
What about the geopolitical data?
That can, it depends on what it is, right? We're having an election. You talked about the election. The stock market makes money with Democrats and Republicans in the White House. It's a little bit agnostic to that.
Are you concerned about war?
I don't know how you can't be concerned about war, and with what's going on in the Middle East, with what's going on in Ukraine. But again, too, like depending on how big the conflict is, it can be a ripple in the financial markets. The bigger it gets, obviously that can turn into something much bigger. So I would say we're concerned about all those things. It's just a matter of how concerned.
Yeah.
And what does the data say?
Yeah. Carl, if you Google Russian warship in the news right now, you can find it. Nuclear submarine, off the coast of Cuba, a warship. I mean, looks like posturing. They say, no, this is standard exercise. What is your opinion on what's happening with Russia, Ukraine, China, Taiwan? I mean, how are you looking at this from a geopolitical aspect and saying, is there a black swan event,
right,
potentially?
Yeah, I think I would agree with Josh and to your point that the world seems like it's becoming a more dangerous place. We've had these conflicts that are, multiple conflicts seem to be erupting around the world. We hope it doesn't get to that point with China, but clearly tensions continue to rise. Our economies are seemingly decoupling after being very coupled for a long time in terms of trade and different economic links between them and that sort of thing. So from an investment standpoint, it's very hard to kind of game plan around geopolitical risk because, like to your point, they can erupt at any time. You're not really sure what's going on, at the upper level of some of these governments. What I would say was, and some of this might be a little bit boring, but from an investment standpoint, again, you want to be diversified because whenever this stuff does break out, you're not going to be sure exactly. So, hopefully people are taking the appropriate amount of risk for whatever makes sense for them. And then beyond that, individual holdings, it can make sense to consider some things that are a decent hedge for geopolitical events. Gold would be one of them. it tends to respond pretty favorably. Oil does sometimes as well, especially because a lot of the conflicts involve countries in the Middle East. So oil a lot of times will get a bump. So if you're more worried about geopolitical risk, it might be that you think about incorporating some of those specific types of ideas to kind of fill out your overall portfolio alongside other things like stocks and bonds. And that may help when some of these things start to erupt. But I would agree that the world is becoming a more dangerous place, and that is worrying. So
yeah. I just think about the housing market and what would happen in the event of, I mean, God forbid it would be anything that would be here, within our country. But what would that do to the market, the housing market, and people's ability to pay and their mortgages and things like that? And what would that do to the GDP? Should people continue to not have money to be able to spend to keep the economy going? Let's talk about housing a little bit as we kind of wrap up. We just had you guys on our Tuesday night podcast, Tuesday night live show. Definitely people should check it out, and all your information is in the show notes. We encourage anybody interested in financing, certainly in the Mid-Atlantic area, to reach out to you guys. But let's talk about the housing market a little bit, because there's a lot of news going on with REITs and multifamily and commercial, and that's kind of imploding, where we're seeing commercial properties being sold for literally pennies on the dollar, and I think we're just at the beginning of that. But I'll talk to you about this, Josh, first. What I see from an investment standpoint, most people aren't prepared financially when they get old. I mean, we look at the aging population. Social Security is inadequate. Medicare isn't worth anything. I mean, if you don't have a supplemental plan, I don't say it's not worth anything, but it has its limitations, right? You work for 40, 50 years, you pay into your FICA, your Social Security, your Medicare, your employer matches it, 16% almost of your money that you're not getting in your pay is being offset for one day in time that they've extended this date beyond, and they keep pushing it back. And when you're 67 years old, you get this now, right? Or whatever the current age is. You look at that and you go, man, you guys are living on $1,600 a month. And of that, you're paying $147 towards your Medicare, right? So it's coming out and you're like, man, you guys don't have any money. And they're saying, what can I do now, right? But what I see all the time, which is tragedy, is that the only investment that a lot of these older folks have ever made is buying a home. Mm-hmm. And I've spoken to financial advisors before, and they say this is a colossal mistake. Because you haven't done anything but invest in a home, buy a home, and now you can't get your equity out of it unless you do something like a reverse mortgage, and you're going to lose you can't give it to your kids now because its value is declining because you're spending your money to live, and you're not really living, because it's not like you're still making enough money to pay for all your medical bills that you have. People buy houses, they don't put furniture in it. They want a big box. We've gotten into this environment of McMansions. Should people buy houses? Should people buy houses? You have a daughter that just got married, wants to buy a house. Is that smart? Should they buy a house, or should they invest their money and focus on taking that money that they're wasting? I mean, you can rent right now for a lot less than you can buy. Are they smarter to rent and take the money and invest it?
I mean, I think it depends. And one of the things in our job is that no one person or no couple is exactly the same as everybody else, right? So a lot of it's going to be based on their situation. And, fortunately for our firm, I mean, a lot of the people that we work with, they can do both. And they can do both really well.
What about the people that can't?
I mean, that's really tough. And I think, again, I do think buying a house is becoming less affordable.
Should you spend 50% of your salary on
you shouldn't. No, you shouldn't. And that's the thing too. So, we talked about debt earlier. We talked about financial education. I mean, there's so many things that you can do and good habits that you can start, when you first get out of college and start working. A minimum saving 10% of your paycheck, into your retirement. And I kind of talked to, and this is pretty basic, but my daughter just got married first thing I told she and her husband is, create an emergency fund. I'm going to say 3 months. Let's start with 3 months of expenses, right? 3 months of expenses in a CD or money market, and then start, plowing as much as you can in your 401k and do the Roth option. Don't get used to that tax break. You don't get used to it. You don't miss it later on. And then you start doing other things. So we're all about, with kind of, I would say, second generation or third generation clients, trying to educate them on, some of these steps that they can take early on to try and help them achieve their goals. I'm going to still say, yeah, buying a house would be a goal for me and for, a lot of the people that I'm talking to, but it's not the slam dunk that it used to be. It's not going to be for everybody anymore.
Well, you used to be able to buy a house and afford it on one salary, and mom can stay home and raise the kids.
Correct.
Now you can't buy a house without 3 different jobs from both mom and dad.
Or a nice check from your parents for the down payment.
That's correct.
Which, by the way, is something that, a lot of our clients do for their kids.
Yeah, right. Well, they're the ones that already have the money. But Carl, what about you? Let's have you answer that question.
Yeah, I think one of the issues right now, to your point, is that, and I agree with Josh, the affordability is as worse as it's ever been for houses when you factor everything in, and particularly the level of mortgage rates now that have, just about doubled over the last few years. But the market's chronically undersupplied. I mean, a big part of that is existing owners, when rates were very low, or feel like they're locked in now. They don't want to get rid of their 3, 4, maybe up to 5% type mortgage and have to turn around and go buy a new place at 7 or whatever the going rate is right now. So that's one big part of it. And then I think you alluded to this earlier, a lot of people are opposed to new construction, which we desperately need, whether it's zoning, tough zoning requirements or different things like that. Everyone says, well, we need more housing, right? But then nobody wants it built next door to them, right? So I think addressing that.
Well, you're talking about affordable housing.
Affordable housing.
Yeah, right. Yeah. They all want it, but they're like, but not here, not in my neighborhood.
Well,
let's put it somewhere else. We don't want to put it here.
And just more in general. I mean, I think most estimates, and especially because of what happened coming out of the great financial crisis, is that we're undersupplied by about, I think it's 4 to 5 million units nationally that we need, that where we should be at when you looked at the prior trajectory of, home building.
Based on headline reporting.
Yeah.
Yeah. I mean, there's a lot of second homeowner, third home. I mean, they've got vacation homes, sit vacant, condominiums, stuff like that. Yeah.
So anyway, I mean, I think until we can address that issue of supply and having more of that on the market, some of that is related to rates. So there are some speculation about maybe rates starting to come down later this year. That might help to unlock some of the existing inventory that seemingly is locked up right now. Maybe that would help a little bit, but I agree right now the affordability is like a real challenge for a lot of people.
I think if I was Secretary of HUD, one thing I would be, triumphing for is to cut some of the red tape. You mentioned it, the zoning issues that we have. And one of the problems why we don't see more affordable housing being built, and I'm not talking about government subsidized homes. Mm-hmm. Okay, because there is no affordable housing to that. When the government shows up and says, I'm here to help you, I mean, what happens. You spend, get back to the bag of rivets, right? I mean, the policies, it's a money-making thing here, right? For whether they're getting tax credits or whatever, but there's no cheap way to build. What you really need to do is encourage developers to build the 1,600 square foot cookie cutter, basic need housing that we had post World War II.
Starter homes, right?
Yeah.
And not even, because it may be somebody's forever home. When we look at when I was growing up, and you guys may be a little bit younger than me, but when I was growing up, a lot of my friends' parents are still in the houses that they were in back then 30 years ago. Right, and they would be considered a starter home. What do we need? I mean, the kids move on, they grow up, they get out of the house. We're down to basic housing needs, right? What do you need? You need a safe roof over your head. But I think cutting the red tape for these communities and these developments, because the developers and the builders have to spend so much money in infrastructure costs. Before 10 years ahead of time, before they can even stick a shovel in the ground, they're spending hundreds of millions of dollars. Of course, they're only going to build a big enough house that they can make massive profits on. If the costs were a lot less, they could make money and be encouraged to build a smaller house. And I think we need to bring that back. But I think, it's been great conversation. Did we solve the world's problems? I don't think so. But I think, when we talk about have shows like this or interviews like this, it really kind of opens up the minds of people that they can say, hey, I should be more interested in financial literacy. I should be thinking about these things. I should have a reserve account, an emergency fund, should invest money and things like that. So for our audience, Josh, I guess would be the contact person, really, for the consumer facing side. But who can contact you? Because, think about your daughter that just got married, and, how many people out there that are millennials, whether they're married or not, whether they'll ever get married. But when they think about, I've just started out in the workforce, I'm overwhelmed with debt, everything, pressures to keep up with the Joneses. Where should they start, and sort of like what entry level can people reach out to you? I mean, I told you that I want to invest $100 a month. I mean, is that who could call you, I guess?
Yeah. I mean, so our firm, CW Advisors, we have about $7.25 billion under management. We do tend to work with the kind of the affluent audience. Our firm minimum is actually $500,000 of investable assets. There are great resources though for folks that are under that.
Yeah.
One of our partners or two of our partners are Schwab and Fidelity. We do a lot of work with, Fidelity has a program called the Wealth Advisor Solutions Program. We're a part of that, where they refer us business that, isn't really a fit for them. Schwab has something similar called the SAND Network. Same thing. But both of those companies, for folks who are kind of under that 500,000, those are both great resources. And then the other one is actually from a planning standpoint, the CFP, so I'm a certified financial planner. The CFP network, they do pro bono work. So, you can reach out to them through their website, and a lot of times they'll do pro bono work. If you wanted, more specific planning questions. But Schwab is a great resource. If you're not a fit for us, Schwab's a great resource. Fidelity, Vanguard as well are all good resources.
Excellent. Well, good. Well, we'll keep our eyes and ears open and what the markets are doing. And thank you guys so much for coming in.
Thanks for having us, Todd.
Thanks for having us.
Appreciate it.
All right, thanks so much for watching. Hey, they're good guys, but I can see why you might not like some of the things that they had to say. But I do believe that we did get a lot of honest opinions and answers from them, despite the precarious spot that they're in with advancing any self-fulfilled prophecies should their clients be nervous to their opinions. If you liked the video, you can let all of us know that you did by hitting that thumbs up, and I'd love to know your thoughts. You can drop your comments below. I love reading them. And guys, if you haven't subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And if you think this video would be valuable to some of your friends or your family, please consider sharing it. The share button is below. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.